accounting for depreciation and disposal of assets. What is depreciation? Depreciation is an accounting method that allocates the cost of a tangible asset such as property, plant, and equipment over its useful life to reflect its decreasing value through wear and tear, obsolescence, damage by accident, or technological improvement. These assets are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. Instead of expensing the entire cost upfront, a portion is recognized as an expense each accounting period, which impacts the income statement, reducing profit, and the balance sheet, lowering the asset's book value. This helps businesses avoid the appearance of financial loss from large upfront expenses and matches the cost of assets with the revenue they generate over time. Reasons for providing depreciation. Prudence concept. Profit will be overstated if depreciation is not charged against income during an accounting period. Depreciation gives a clearer view of a company's financial health and performance. Matching concept. Depreciation is an expense and must be properly matched against income generated during a financial year. Other reasons for providing depreciation are tax benefits. Depreciation is a tax-deductible expense. This reduces taxable income and, therefore, the amount of tax a company owes. Managing company assets. Depreciation helps businesses track the value of their assets and plan for future replacements. Common methods of calculating depreciation. Various methods of depreciation allow companies to choose the approach that best matches their financial and tax strategies. Understanding these methods is essential for certain business owners and investors, as they can substantially influence reported earnings and tax obligations, particularly in industries that heavily invest in physical assets. 1. Straight line method. According to this method, depreciation is calculated as a fixed percentage of cost. It is mostly used for non-current assets such as fixtures and fittings, which is consistently used over its useful life. Under this method, depreciation can also be calculated using the following formula. Depreciation equals cost residual value / useful life. Cost. This includes the purchase price and any expenses to get the asset ready for use, e.g. carriage, installation charges, etc. Residual value. This is what the company expects to receive for the asset if it's sold, scrapped, or traded in. Generally, the longer the useful life, the lower the residual value. Sometimes, the residual value is zero useful life. This is the estimated period of time that the equipment will be productive for the business, which isn't necessarily how long the equipment will last. Instead, it's the period it's expected to be used by that specific business. 2. Reducing balance method. According to this method, depreciation is a fixed percentage on its net book value each year. Depreciation equals cost in 2024. DEP 2024 equals NBV, net book value. NBV 2024 DEP 2025 equals NBV 2025. It is mostly used for machinery, since it produces more during its first years of trading. 3. Revaluation method. According to this method, depreciation is the difference between the value at start and the value at end. This method is appropriate for businesses that have many small items of non-current assets, example loose tools. Depreciation equals balance at start plus acquisition, disposal, balance at end. A non-current asset may also be revalued upwards. For example, land does not depreciate, but it may be revalued upwards. In this case, a revaluation reserve must be created and recorded as part of the equity of the business. Revaluation reserve may be calculated as follows. Revaluation reserve equals revalued amount, cost, accumulated depreciation, equals revalued amount, NBV. Each time a non-current asset is revalued upwards, its provision for depreciation must be eliminated, debited, and the amount of revaluation reserve must be credited to the reserve account. Disposal of assets. Asset disposal is the process of removing a fixed asset from a company's books, which involves removing the asset and its accumulated depreciation and recognizing any gain or loss on the sale. To record a disposal, you first update the depreciation to the date of sale, then debit the accumulated depreciation and credit the asset account for its original cost. The difference between the cash received and the asset's book value, original cost minus accumulated depreciation, determines if there is a gain or loss, which is recorded in a separate gain or loss account. Steps for accounting for asset disposal. 1. Update accumulated depreciation. Calculate and record depreciation up to the exact date the asset is disposed of. 2. Remove the asset. Credit the asset's original cost to the asset account to remove it from the books. 3. Remove accumulated depreciation. Debit the accumulated depreciation account to remove the total depreciation recorded for that asset. 4. Record cash or other consideration. Debit the cash account, or a similar account, for the amount of money received from the sale. 5. Determine gain or loss. Compare the asset's book value, original cost minus accumulated depreciation, to the cash received to determine if there is a gain or loss. 6. Record the gain or loss. Gain. If the cash received is greater than the book value, credit the disposal account for the difference, the gain. Loss. If cash received is less than the book value, debit the disposal account for the difference, the loss. Thank you.